Yeah, we okay? Hello, nice to meet you all. Hi. So obviously it was a little bit short notice, so this is a bit of a scattergood approach. So we're just going to go over lots of different things, and if it's more or less relevant for you, I'll just ask you questions and you ask me questions, and we'll just make it more tailored to you. So just because it says stuff on there doesn't mean we have to talk about it. We can just talk about, I'm just here to help you out, basically, give you as much advice and guidance that's specific to you as possible. So I think it goes on to it at the end, but yeah, as you said, I'm Dan. I work for a company called UHY Hacker Young. It's one of the top 20 accounting firms in the UK. In Manchester office is like 120 staff, 15 partners. It's quite a chunky firm. And I've been there for 4.5 years. And I've been working with the University of Manchester, which is how we've connected for about 6 years now, doing this sort of thing. So yeah, sort of fumble my way through. And I just want to reiterate once again, if it's not relevant, we'll move on. Yeah, it's not an issue. This is just an overview if you're creating a business plan of the key sections that you'd include. And whilst the section 1 is the executive summary, who here has got a business plan, by the way? Has anyone got one yet? Yeah? All of you? Okay, well that's good. Does it roughly follow this sort of structure?
It sounds a bit too formal for what I thought I had.
Right, well, it doesn't, obviously a business plan is tailored to you, but the executive summary is something that you'd put at the front to sort of just summarize everything that is in the plan, but I'd recommend you do that last, because if anyone of you tried to start there, you're gonna fall on your face, because you don't know what to put there until you've done the rest of it. So, and I think you're recording these and you've got these, haven't you, to distribute the slides if anyone needs them afterwards, so don't worry about taking pictures and stuff. In section 2, I'd say put some goals, your mission, what your USP is. You also should detail, if you've got any other members of the team, just detail out all the members of the team as well. Am I preaching to the choir? Do you all have a very good business plan that you're all happy with?
I think the current thing is a lot of people have thought about their business plan, maybe more of the key aspects, but it would be good to how to formally structure it.
Okay. Right, we might move on to that in a bit then. So things to include in your section 3, I'd say you need a breakdown of all your products and services if you've got them, how big your business is, kind of where you're up to, if you need any patents or if you've got any patents, details of that. On your 4th section, where your market, you're looking at who your customers are, how big your market is, where the market's projected to go and who your competitors are. Section 5, how you'll make it, I'd like to call it. I say that what's your sales strategy, what's going to make you different, etc., etc. And section 6, we'll talk about in more detail. So I think this is the bit where we start looking at words that if we've not made familiar with them, we don't know what half of these mean. I know I didn't when I first started, and part of the uphill battle with accounting and finance is understanding what the fuck everyone's talking about when it's like equity and grants and debt and all this sort of stuff. So on the left-hand side, I've got sort of, if you're starting a business, you need money. And these are the typical ways that you're going to access money. Debt finance, anyone know what debt finance is? Everyone knows what debt finance is. So it's loans, interest loans, loans from the bank, loans from funders. Does anyone know what typical interest rate would be for a startup loan? 6%? Ours is usually about 12 to 15%. It's thieving, it's horrible. But obviously we've been lucky over recent years because of, well, not lucky obviously because of the pandemic, but the government support available from the pandemic came in the form of loans, and those loans were sort of 2.5% interest, so crazy good loans. And for the first year, you didn't even have to pay anything, the government paid it. We've been spoiled a bit, but bringing it back down to earth, getting a loan as a startup is not only almost impossible, but if you do manage to achieve one, it's sort of 12 to 15% interest, unless you get very lucky. Does anyone know what equity finance is?
Giving a part of your company?
Yeah, so it's selling shares or issuing shares, more common, issue shares and get someone to pay you for that. Again, wildly uncommon for a startup business, which leaves us with the most common option for startup businesses is grant funding. And there's and not just grant funding, but group that into like all the awards that are available and sort of competitions you can go for to access pools of money. The hard part about grant funding is that you typically need a full-fledged iron-tight business plan, and because there's no interest and because you have to pay it back, the competition is huge. So you need to make sure that you have the best finance in terms of the finances. You need to stand above the rest in terms of that. So yeah. Does anyone know what cost per acquisition is? Because it's something that's really important to put into your financial projections that sometimes people don't.
How much costs it getting a customer?
It's spot on. It's how much you're projecting each customer costs you to acquire. And the main cost of that is obviously marketing costs. So in your plan, make sure you've got an idea of how much, if you're projecting you're going to get 10 customers, then 15, then 20, then 30, how much that's going to cost. Because then an investor, potential investor, could look at that and see whether you're deluded or whether you've got a good idea of the market. Because for this, exactly, if you're looking at Instagram adverts and Facebook and stuff like that, you need to have a rough idea of how much it costs you. If you run £100 of ads for every day for 7 days, what are you expecting from that? You need to at least have a rough idea, basing it on other businesses in the sector or your mates if they're running ads, or just trial run it and just see what you get, and then you can implement that into your plan. Okay, forecasting. What would be? Have you got forecasts? Have you produced a forecast for your business? That's fine if you've not. It's not an issue if not. What are the three types? Have you got a full forecast? Have you got a profit and loss, cash flow, and a balance sheet forecast? Nice. How long is the forecast for?
I think it's 3 years.
3 years. Okay. I think that's fine. I'd go lower, to be fair. It's up to you. Obviously, you know what your goals are better than I do. But typically, anything past 2 years is just pure. It's just pure speculation, isn't it, at that point? The first year is you can have a good idea and you can sort of tail that off and to say the next 6 months, like 18-month or 2-year forecast. That third year is probably where on your forecast, I might be wrong, but your numbers start to go a bit mental. Like, wow, it's going to go really well. And it's just because we don't have a clue at that point. A lot of real businesses will forecast for 1 year, take that out, and then every 3 months have like a rolling forecast where they assess how they're actually doing it on a 3-month basis. You can forecast, there's nothing stopping you from forecasting for 5 years, but there isn't a lot of value in that time after that 1 to 2 year mark. So don't spend loads of time doing it, I'd say. I'd focus on that first year to 18 months, make sure that's really solid. And in terms of so for example, you've got a product that you've not started trading with yet. So like you're developing an idea or you're developing, you're researching the market or you're developing a product. Do you start the forecast from like now, or do you start it from day one of when you want the product to launch? Usually you'll start it from day one of trading, day one of when you actually expect the product to launch. And the build up to that, you'll just have as some dialogue in the business plan or in the presentation or the pitch. You just have it as a bit of context, how we're going to get there, roughly what the R&D costs are, and then have your forecasts being 12 months of actual sort of trading activity. I think that a lot of startup businesses often have a really good understanding of their costs to bring the product or service to market, but then it sometimes gets a little bit blurry after that. So you need to start thinking about where you'll be operating out of. Do you have to hire a workshop space? Are you going to work out of home? Are you going to go to a co-working space? Are you going to get an office? You need to sort of put these costs in. Does anyone know what business rates are? Would we be guessing if we said we did? Business rates, we all pay, some of us will pay council tax, which is the tax on living in a house or a flat. Businesses pay business rates. It's just council tax for businesses. You can actually work out if you're thinking to start my business, I want a little office space and I want it in the centre of Manchester. You can go online, you can Google business rates calculator, and it's all calculated on your postcode and the square footage of the office. So it's a cost that you don't think exists, but it will exist if you move a business. If you operate a business out of a property, you have to pay a business rate, but you can go and calculate that online. So keep it in mind if that's something that you might be doing. So it's gov.uk is where the calculator is. Bills, utilities, especially if they're not included in your lease. Insurance, does anyone know what insurance you need as a business? Depends what you're doing. You're right. You'll sometimes need PI insurance, and PI insurance is only really if you're giving professional advice. All businesses will need some sort of business insurance, but the cost is sort of like 100 quid, 150 quid a year. It's very minimal, and you can have quite a big liability from that amount of money. So don't think you need to spend loads on insurance, but just general business insurance is quite cheap. You only ever need to get any others if you've got specific needs, like you said, if your business does a lot of advisory work or consultancy work, or you're going to have, if it's like you're building stuff and you're going to have people walking around and potentially having rocks falling on them or something, you'll need different types of insurance for that. Staffing, right. So do we all know, we obviously all know that when you get paid, you receive that amount net of taxes, right? Net of PAYE and net of national insurance. Do you know that as a business, when you pay staff, you have to pay extra? Yeah,
You have to match the contributions.
So yeah, that's one of the things, is that if you've got a staff member on a payroll, so let's say you've got a staff member, they're employed through the business, they're on a payroll scheme, you as a business owner need to match their pension contributions to a maximum of 2.5%. So if that employee will be making contributions to their pension scheme at 2.5%, you'll have to match it at 2.5% as well. There's also massive tax called employers' national insurance. Not a tax, it's national insurance, but it's an extra cost. If you hire somebody, if their salary is 20 grand, you as a business need to pay 13.8% extra as national insurance. So it makes that employee actually cost more to you than you thought originally, especially when you then add the pension contributions on top of that. So when you're doing a forecast, when you're hiring people, you need to make sure you're thinking about all these extra costs. So if you're going to hire a load of subcontractors or self-employed people, what's the main difference, do you think?
It's their responsibility.
Depends. It depends. But so if I'm working for you, and instead of you employing me, I think, right, I'll just send you an invoice every month for my services. You need to really, really watch out for that, because what am I effectively dodging? I'm dodging national insurance, and so are you. You'd be dodging paying national insurance on me. What Hmrc would look at is if that person is deemed to be an employee of your business, like basically, there's like a test you do. So if they basically work mostly full-time for you, if they don't really have any other customers, if you give them everything that they need to do their job, they're really an employee. They're just trying to dodge the national insurance, and people get caught out with that all the time. And it would mean that the employee has to pay back national insurance that they should have paid, plus interest on the late payments, and the employer has to pay national insurance that they should have paid, plus interest on late payments. So just keep in mind that if you are going to hire freelancers, they need to be, it is your responsibility to know if they're deemed an employee or not. It is your responsibility as an employer. Because if they are deemed an employee, then you're going to have to pay national insurance on that.
And is that boundary clear cut?
There's a test. There's a test you can do online. If you go gov.uk, or if you just Google IR35 test, and it'll come up. Don't delve into IR35 too hard, because then it starts getting weird. IR35 is a piece of legislation that says if I set up a limited company, and then that limited company bills you for services, this limited company here, really, I should be paying national insurance on whatever that pays me, and that company should be paying national insurance on whatever it pays me to the government. IR35 is to do with companies. I'm already boring myself talking about it, but the rules of IR35 apply, where it's if somebody is deemed to be an employee of a business, the employee needs to make sure that they're on the payroll, and the employer needs to make sure the employee is on the payroll, because both parties are dodging national insurance.
I imagine that has to do with like hours worked and...
Exactly, it's hours worked. It's whether the weird one that they really hang on is whether you could send a substitute, is what they say. So I couldn't send a substitute to be Dan Thomas at UHY. They'd be like, who the hell are you? How do you know the door code? And as a result of that, I'm an employee. If you've got a subcontractor, you'd probably be a bit annoyed if they just sent someone random, because it's like, well, I interviewed you, I wanted you to do the job. If they can't send a substitute, that typically means that they're deemed to be an employee. Whereas if you truly had a relationship with an agency, and you're like, I just need you to do my customer marketing for me, you don't necessarily care if it's Gemma or John who does the marketing, as long as it gets done. And that's because they're not an employee. Does that make sense? So yeah. There's a few things that you test, but that's the one that catches people out. All right. So there's loads of different types of businesses that you can set up. A business is just a means of buying and selling stuff. It doesn't mean that you're a company. It doesn't mean anything. It just means that you buy and sell stuff. So does anyone have a limited company here? Yeah? Is anyone operating as a sole trader? Partnerships? Anyone? Well, as you may or may not then know, the main difference between having a limited company and being a sole trader is what we call limited liability, which means that if you piss someone off royally and they sue you for 50 million quid, Your business, you can only ever, as a person, if you own the business, you're only ever liable for what you've put into the business. Whereas if you're a sole trader and they sue you 50 million quid, you'd be living out of a box for the rest of your life because you've got no protection. But the disadvantage of having a limited company is the extra admin that comes with that. A limited company has to file accounts every year. They have to file confirmation statements with Companies House. They have shares. They probably have an accountant, etc., etc. Not that you wouldn't have an accountant as a sole trader, but there's more to do. So having a limited company is a little bit more admin intensive, a bit more expensive, but it has a lot of benefits. One benefit is that it protects you because you've got limited liability as a shareholder of that company. So as I said, if you get sued or anything happens, or you just simply run out of money and you can't pay people anymore, you can't pay suppliers, it's fine. The business goes down, you lose whatever you put into the business, you move on. Limited companies also have shares. You can have companies that are unlimited, like partnerships, and also, what's the one? A limited by guarantee. These companies don't have shares. I know this is really random and none of you will ever need this information, but never, ever, ever set up a company limited by guarantee. Ever, no, never do it. It's always a bad thing. Anyone suggests it to you, they're an idiot, tell them to go away. What it means is that you'd have a company that has no shares. And what's the key thing you can't do when you have no shares?
Make decisions.
No, because let's say it's limited by guarantee, sorry, so you'd have I just spat really far into, if you've got a company limited by guarantee and you've got an agreement that says, me and you, we guarantee the business X amount each, you can make decisions still, that's fine. The key thing is that in order to pay yourself dividends, you need shares. So what that means is that nobody's going to want to invest in your business because they then can't take dividends out of the business because there's no shares. You can only pay dividends against shares. So just don't do that, it's really silly. Does anyone know what a community interest company is? Have you got one?
Well, I was thinking about going into Accelerate Me is a CIC.
Is it a CIC? Accelerate Me. I really like CICs. They're a limited company. They are for profit. You're allowed to make profits. It's like a hybrid between a limited company and a charity. You're allowed to make money. However, there's a bit more admin involved. You have to produce a return every year. But I think the main benefit of a CIC is it gives that perception, because you have to produce that mission statement every year where you do your values and your goals, that you're a company that wants to do good and you're in for sustainability and all the good things that come with that. And some investors find that quite attractive because they think their money's going to a more sustainable entity, and it has shares. So you can issue shares and do dividends and all that. Anyone have any questions at this? We'll do a Q&A at the end. I've just said all that. Who here has trouble figuring out how much to charge for what they're selling? I have a really, really good piece of advice. It's totally unique to you and I can't help you whatsoever. Basically, the hardest part of selling stuff is figuring out how much to charge. And the way that I tend to sort of go about it is lots of ways. For example, when you're building a forecast, I tend to go with what you know first and then go to what you don't know last. And what you don't know is how many people are going to be interested in buying your product or buying your service. That's the unknown, isn't it? Unless you've got orders in the book, you don't know how well it's going to go. So what I would suggest is go build a forecast based on all the resources you need as a business, the staff, the rent and rates, the telephone, the internet, the everything else, and then come up with a goal. And if your goal is to, after 2 years, be able to pay yourself a salary of 35k or 40k, if that's your goal, work backwards and figure out how much you need to sell at what price over what period, with some nice natural growth in there to get to that point. And then you can say, well, does that mean that I have to sell at 50% less than what I thought? Fantastic, you're already at a good start. If it then looks like that's going to be too expensive, whatever that pumps out, then you can reassess whether what you thought was the costs need to be pulled back a little bit. That's how I'd go about it, because it's really, really hard to figure it out when you're doing a forecast, especially if you've not sold anything yet. Anyway, hands up if you know what economies of scale are. Okay, hands up if you know why they can be bad. No?
Does they require like a minimum maybe amount of revenue? Or else?
Potentially. I think whenever someone sees economies of scale, they see it as the golden goose. It's like, I want to be able to scale it really fast so I can buy loads at a cheaper price and therefore make loads of money. but there's quite a lot of issues that come with economies of scale that people sometimes don't appreciate. Number one is, where the hell are you going to put all the stuff? And if it's a product, you're going to incur lots of storage costs. Getting storage space is expensive, it's difficult. Managing that much product as well is a lot harder. If you have to grow, if you're selling loads more things, you're going to have to grow your team, which means that your hierarchy is going to start doing this, which means that the people who started the business with you are going to feel more disconnected from where the business started. So all I would say is, on your forecasts, don't really think about economies of scale too much. I see it quite a lot where they sort of think, but if we sold this much, we'd do great. And it's like, well, scale it right back, because economies of scale aren't always a good thing, especially for a startup business. That's what I'd say anyway. You also lose a bit of control when you start doing economies of scale. Likely your payment terms go down the shitter as well. So you're going to have to wait a long time before you get any money for things, and it starts to get very messy. Because obviously cash flow is the pinnacle of starting a business, isn't it? Does anyone have an idea of what break even means?
Only in macroeconomics. Like,
It's probably that right. Yeah.
So revenue covers your costs.
Yeah. So it's the point at which you start making enough money to cover all your fixed costs and the costs that come with selling stuff. So obviously your business has got costs that you can completely forecast, like your insurance, your rates, your rent. If you're going to take a salary out X amount, that's X amount. And then every product you sell might have an associated cost, like marketing or materials. I've deliberately got no idea what any of you do, because if I did, then I feel like I might go off on random tangents. So I'll ask you all in a minute what you all do. But break even is obviously the point where after you've sold this much, everything after that is glory. Like everything after that's really good. And I don't know if this is going to work. Hey, there it is. Little lines. Look at that. That's your break even point. So if we're selling 75 units there, we're good. If my sales forecast reckons I'm going to sell, oh shit, sorry, I'll let that bounce. I interrupted it. There we go. If your sales forecast reckons that you're going to sell 110, this is therefore your margin of safety. And this is the actual useful part of break even. This part's not useful. You don't want to break even, because that's really scary, because then every day you're thinking, oh shit, have I got enough money? This margin of safety is what's really useful. Because that says if I'm thinking I want to sell 110 in the first year, and that leads me to this point here, I can actually drop my price a bit and remain within this, and sell less units, and I can edit my forecast to make sure I still stay within the nice triangle, but I can reevaluate, and that might mean I can open up opportunities. So that's the most important bit. Cost base, yeah, we sort of talked about that. I'm assuming most of you have heard of this, but I like that saying. A lot of businesses throw the turnover figure out. It means absolute donkey. It means nothing. Profit is the bottom line, is what people really look at. But in reality, if you're making loads of profit, accounting's really weird in that there's a big disassociation when people think high profit means you've got high cash. It's totally rubbish. You could have high profits because you've got sales that haven't come in yet, and you've not got costs that you've not had to pay for yet. You'd have great profits and no money. And then it doesn't matter how profitable you are, you just run out of cash. We can talk about that in a little bit. This is just an awareness point. You're going to get these slides. You can read this yourself. I don't know why that says break even and margin safety at the top. I did this in a rush. These are different schemes that investors use. You can sign up for these schemes. They are complicated to sign up for. You'll need some professional advice. But investors like to invest in businesses through these schemes because they get loads of tax relief. So if there's a way you're looking to access investors and access funding, Google these two schemes and see whether you would qualify on these schemes. It's basically, one's called EIS, the Entrepreneurial Investment Scheme, one's called Seed EIS. They're very, very similar, but Seed EIS is for smaller businesses. Investors, when they invest in businesses through these schemes, for Seed EIS, for example, they get 50% income tax relief. So they'll pay half the amount of tax if they invest in a business through the scheme. So it's wildly popular to do this. So just Google them in your own time. Little things to watch out for. Unforeseen tax. Or what turnover do you need to be to register for VAT? Close. 86,000. The rule is If at any point in the next 12 months you think you're going to make 86,000 in that 12 months, you have to register for VAT. That's the rule. It's up to you to make that decision. If one day you look back on the last 12 months and you've made 86 grand, you're in shit because you should have registered 12 months ago. And the revenue on your first VAT return that you ever do, the revenue will probably look at it. And if they look at it and see that you should have registered a while ago, they'll cause you a load of issues. So just remember that if at any point in the next 12 months you think you've got reasonable information to conclude that you're going to make 86 grand in turnover, you need to register for VAT. Everyone knows what the VAT rate is, right? 20%. Does anyone, sorry, do we know what VAT is? Okay, if I'm going too fast, I am really sorry. So VAT is Hmrc's laziness, basically. It makes us collect tax for them. So I sell to you, and I'm a VAT registered business. I sell you my products, it costs £1,000 to you, but I have to charge you 1,200 quid. And that 200 quid that you then pay me, I have to just leave for a bit, and in 3 months' time, all those 200 quids that I've got, I have to pay to Hmrc. So it's me just collecting tax off you for them, basically. You have paid me £200 of VAT. In 3 months' time, you can tell Hmrc, hey, I paid this, and then you get it back. So I pay Hmrc and then you get it back. It all seems very, very pointless. But there is one loser in VAT. We lose, yay. The end consumer loses. When you buy a chocolate bar, you pay VAT, you can't claim that back. So it's the person at the end or the entity at the end that loses. But VAT is not all what it seems. They are quite good with it. You don't pay VAT on stuff that they don't think is fair to tax. Like you don't pay tax on tax, for example. Like you don't pay VAT on your council tax. You don't pay VAT on wages. You don't pay VAT on digestive biscuits because they're apparently not a luxury item. But if you put chocolate on them, you have to pay VAT now. Same with cakes, Victoria sponge cakes, no VAT on them, but chocolate cake you have to pay VAT. Really weird. There's VAT on them. Claim it back, mate. No VAT on milk, bread, all that sort of stuff. Anyway, you might want to register for VAT earlier than that 86 grand limit. Does anyone know why you might want to do that?
Just in case you don't go over and then haven't registered.
If you're being cautious, yeah, that's fair.
Or if you're buying equipment.
If you're buying more than you're selling. So if you're buying all loads of stuff to start the business off, computers and cameras, or more common, you're developing something like developing a new drug, or you're developing a process that just is a money sink, you want to be able to claim all the VAT back on all the stuff you're buying. The catch is you need to be able to prove to HMRC that one day you are going to sell stuff. So they will usually look at your first VAT return and say, you're claiming loads of money. We don't win in this situation, explain. Then you write them a letter and say, hey, don't worry. One day I'm going to make millions and you'll get your VAT. Is literally what you have to do in accounting language. Some things don't charge 20% VAT, which is the rate, by the way, 20%. Some things are 12.5%, some things are 5%. Just watch out. Don't claim 20% VAT on everything because not everything has VAT on it. Does anyone know what corporation tax is? Corporation tax is the tax on business profits. It's 19%. That won't last long. It's going up to, I think, 25% in the next few years. We pay tax. Does anyone know what we pay tax at? What rates we pay tax at? Yeah, in brackets. So we pay like a scaling tax. The more money we make, the more we get taxed. Businesses just get taxed 19%. Deciding whether to pay yourself a salary out of a business and therefore get taxed on your own salary, and deciding whether to take dividends out of a business and then you get taxed on dividends is a massive kettle of fish that you should think about one day. Don't think about it yet. But if you think about it, if you take money out of a business as a salary, that's a business cost. So the business therefore has less profit, so it pays less tax at 19%. But then you're paying your tax on your income. So it's all, you have to sort of do your maths and just figure out which way is best for you. Think about credit terms in your forecasts, especially. If you're doing a forecast, try and build in 30-day credit terms. It might mess up your forecast, I am sorry, but if you've not thought about it, you probably should do. Assume that people won't pay you for a while and see if that messes it up in terms of your cash flow. Because you also need to build in, I didn't mention this, build in some sort of like 10% whiny customers cost, where you just expect customers to try and get refunds or to just not pay you on that sort of thing. Build that in as a cost. Even if you think your product isn't relevant for that, an investor will be looking for it when someone's looking at your forecast, they're looking at it for reasonability. They're saying, have they thought about everything? And even if it makes it look worse, if it makes it look reasonable, that's what matters. Investors aren't looking for the best forecast. They're looking for one that they actually believe and they think, actually, yeah, they've thought about all this. I can't think of anything they've not thought about. They've put you can't go wrong, even though, you know what I mean? That's the mindset you need to have. I've already talked about most of them. Oh, grants. Do you pay tax on grants? Yeah, you do. And everyone thinks you don't. I know. Even if government grants, you still pay tax. It's just income. It's just income for the business. You still pay tax on it. By pay tax on it, you pay tax as corporation tax on your profits. So if you get a grant for 10 grand, and in the same accounting year you spend 10 grand, you've got no profit, so you don't pay any tax. But if you don't spend anything, if you don't spend 5 grand of it, you're going to get taxed on that. So if you get money from a grant, just spend it. Okay. That's it. So I've gone through it really fast, and I like that picture. When I look at it, I think I'm going, hey. You know what I mean? Yeah, that's basically it. But I think at this point, I might just go around and very quickly, if you just tell me what you do, and if you have any burning questions, I'll do my best to just answer as many as I can. What do you do?
I make natural calorie alcoholic beverages and brands. I'm actually a client of UHY, so I can recommend them most highly.
Seriously?
Yeah.
What business? Manchester Drinks?
No, Pentoni family.
Pentoni?
Yeah.
Wow, yeah, because you came through the university.
Yeah, sold Chris yesterday.
Yeah, you gave me a bottle of the gin that you gave him. Yeah, very cool.
Sweet.
Yeah, So would you have emailed me? You?
No, it was Chris and Steve.
No, I mean a long time ago.
I can't remember.
No, fair enough. Because it was you came through the university program as well, did you? Did you not? Yeah. Wow, cool. What about yourself?
Drive goals and percent praise to charity.
Very cool. What's the vehicle? Is it a company or it's sole trader?
Yeah, it's a limited company.
Limited company. Cool. What about yourself? Have we met before? No problem. Probably a night out or something.
Party animal.
Yeah, definitely.
We monitor symptoms for hospitals and doctors.
Okay,
Yeah.
cool. What about yourself? Sounds good.
30-second pitch thing. Me and my co-founder have founded a biotech startup, essentially making 2 separate devices to help alleviate pain, and more specifically phantom limb pain in amputees.
We've definitely met.
We have definitely not.
On a consultation, finance consultation, we have to have. That rings a massive bell.
Unless you've met with my co-founder.
I thought I met you both on a university Zoom 30-minute consultation. No?
Through EFA?
Yeah, through the Venture Further thing. Yeah, that was me. That was me.
Different on camera.
Yeah. Do you remember now?
Yes.
Yeah. Yeah. So yeah. Nice. What yourself?
So I am a mycology education sort of program. We're gonna teach people about mushrooms from like a beginner amateur level, like key stage 2 is kind of where I'm hoping to enter at.
Cool.
Teaching people about how to grow mushroom, like urban mushroom cultivation and then biodesign.
Got ya. Yeah. Cool.
My biggest question at the moment is like, I don't know whether I want to be a sole trader, a limited company, a
Right.
CLC.
I'll come back to that one then.
Yeah.
What about yourself?
I'm the next speaker.
You're the next speaker. No worries then. What about yourself?
Do you make NFTs for other businesses and sports teams?
Okay. Have you had tax advice? Get tax advice, yeah.
I just want to ask you, is there a VAT threshold for the EU or is this the UK?
UK. It's UK sales.
Is it the same threshold for like similar threshold for other countries in the EU?
Couldn't tell you, I'm afraid. You'd have to investigate that yourself. It wouldn't be hard to Google it though. Just when you're saying VAT, that's what we call our sales tax. So just Google country sales tax threshold. Don't call it VAT. It might cost something else. What about yourself? Are you don't have a business yet?
No, we're on the team.
Right. Okay. Fair play. Right. So do I become a limited company or do I do it through a sole trader? It's tricky to say. You can change at any point. Like if it comes to a year down the line and you decide you want to set up a business, you can do that. There's a few, setting up a business, when you feel like, wow, I'm going to take this seriously, like I know that you don't already, but when you think I want to really pump loads of time into this, that's probably the point where you want to set up a limited company. Reason being, when you're a sole trader, all the profit that you make, you can't retain it, which what I mean is if you have a really good year, but so let's say you make 30 grand and you're really happy with that, but you only really need 20 grand, there's not much you can do about that. When you're a sole trader, you just get taxed on what's left. When you're a limited company, you can decide how much you want to take out. Anything you leave in will just carry forward. So it's kind of, I would say being a sole trader is cheaper for you because you can just fumble your way through your own. I'm rubbish at tax returns, but you can do them yourself. You might be able to avoid an accountant for your first year in a bit. Do you know what I mean? So is it more expensive for a limited company? But when you want to take it more seriously and you want to start really getting your business out there, I'd probably recommend incorporating, just because it looks better as well. Typically, you're protected as well. You can decide how to pay yourself. You get a bit more options when it comes to tax, but don't rush into it, is what I'd say. Is that reasonably helpful?
Yeah, I mean, I've just, well, my universal credit person keeps asking me to make my decision sole trader limited company.
Just carry on doing it as a sole trader. I'd say.
Sole trader,
yeah.
Yeah, I mean, I didn't want to pick a limited company because I thought it might look bad as I'm approaching like education systems, like schools and stuff like this. But I don't really see why. Didn't know.
Yeah.
Didn't know.
Yeah.
No.
What's the how do you become a CIC?
You just, when you're setting it up on Company's House, it costs £13 to set up a company, by the way. Don't pay an accountant to do it for you. They rip you off. We would charge. I was baffled at how much UHY charged for a limited company. So I'm going out of my way to make sure nobody does that because it's not a valuable service. It costs £13, and when you set up a company, you can just designate what sort of entity you want to.
But is there like a requirement? Because don't CICs get like a different type of like the community interest companies?
In terms of, you don't have to, all you have to do is you have to be able to prepare, I can't remember what it's called. It's called a mission something or other. I'm looking at you because you have one, but I can't remember what it's called. You have to produce a report every year that says, I'm a CIC, this is my goals, and this is what we've done this year to further those goals. You don't have to have a requirement other than you've got that written down. And to be fair, a lot of businesses will just have that anyway, whether you're a CIC or not. So yeah.
Yeah, it's just it's rated like a mission statement.
That's it. There's a name for it, and I can't remember what it's called, but it's like I think it'll come to me in a minute. Anyone else have any questions about accounts or tax or anything really?
Just walk me through the mechanics. It's clearly like how a big business, right?
Yeah.
But like when you got these responsibilities to, I guess, calculate how much VAT you should be paying or whatnot, like, and you get, like, how much of that falls on you to calculate and then self-regulate or deliver yourself?
It's all on you. It's all on you, really. Yes. Yeah. If you need to be able to decide when it is that you need to register for VAT. You need to also know if your industry is exempt from VAT or not, because things like healthcare, sometimes you can qualify as being VAT exempt, so you can't register for VAT. And like things like children's clothes and stuff like that, you can't register for VAT there as well. So you need to do the research or ask somebody like an accountant, just talk through the business and just sort of get that, yeah. But it is all on you really. And the main thing that is all on you, and I want to hammer home, is employees that want to invoice you. You need to make sure that they're doing other stuff, because if they're not doing other stuff for other companies, you could be liable to pay for national insurance for them, and could be liable to pay national insurance as well. So just keep it in mind. It seems to be everyone seems to think they've found a loophole when they can invoice a business. You've not found a loophole. Like they are very aware of it.
Can you clarify for me what national insurance exactly?
National insurance is like a tax. If you get paid as an employee, it's money you don't see. So you get paid a salary of 32 grand and you'll end up with not that. And part of that's pay as you earn, which is income tax. Part of it's national insurance. National insurance, from my understanding, is that a lot of us pay it, goes into a pot to fund stuff like healthcare and things like that, basically. It's like a tax that's supposed to come back.
Pensions, separate pots.
It's not pensions, it's to do with like, it subsidises sick pay, maternity pay and stuff like that. It's the tax that's supposed to come back, do you know what I mean? It's supposed to be like, if you put into the system, one day you'll be sick for a few weeks and you'll claim sick pay.
Yeah, you claim that from the government.
Exactly.
Not
So it's
from the company.
exactly the company will pay you, but the company will claim it back, and that's because that's what national insurance contributions do effectively.
Oh, so then I got an employee, they got sick, they want to claim.
You still pay. You pay them the statutory minimum.
I dip into the pockets of national insurance.
Correct.
It's not the employee that then dips into the government directly.
Correct.
They're doing that through me. As
Correct.
A company.
You as a company would calculate usually the statutory minimum sick pay, because that's what you can claim. So you could just pay them the full salary, but you'd only be able to claim sick pay for. Sick pay is a pittance. It's a terrible amount. It's very small. Same with statutory maternity pay and paternity pay and stuff like that. But that's where it comes from, theoretically. I bet they don't have a big pot that comes out of it. It just all goes in, and then they just give us some back, basically. Yeah. Any other questions? Yeah.
In relation to tax, how come us consumers we pay tax in brackets? When it comes to corporation tax, businesses get paid?
Well, businesses used to get paid in brackets, actually. It was until I think it was about 10 years ago. I don't know if anyone else knows, I can't remember. I was not doing what I'm doing now that long ago. In terms of why, I don't necessarily know why they made the decision. It would have been a Conservative government that made the decision to incentivise businesses to come here, because lower tax, get them over here, get them doing stuff here, get us the money rather than another country. Obviously, in the UK, we're always competing against neighbouring countries for business. Like a lot of businesses like Google, they set up in Ireland. Uber, for example, they're in Amsterdam. Like they set up where it's best for them to set up. So when you're taking money out of a business as well, it used to be that you could calculate very meticulously how to take money out of a business in order to minimize how much tax you pay, right? So you'll pay yourself a little salary out, and that'll make sure that you're paying £1 of national insurance every year so that you've put into the system, but you pay no tax. And then you'll take some more money out as dividends. And you know what I mean? So you'll mix and match it. What I will say, a big piece of advice is that nowadays, the tax rates are aligned such that it doesn't really make much of a difference anymore. If you pay yourself a salary, you're not going to be that much worse off by doing all the clever take dividends out, take salary out, claim this, claim that. So it actually does generally work out the same for businesses and for people. Yeah.
If you do set up a company in another country and then you're still trading in the UK, what taxes apply?
Wow, that's a high level question. But if you will pay tax on basically your worldwide income most of the time, but I'd speak to a tax advisor specific to what you're doing. There is obviously you're at risk of paying tax in 2 countries. There is relief for that, so that won't happen as long as you've set it up properly. There's something called double taxation relief, but you do get stung in that you'll pay tax at whatever the highest was. They'll get you in one way or another. But yeah, you'll have to get some tax advice on that. I'm self-proclaimed, I'm not a tax advisor, I'm an accountant, so yeah. But if you have any tax questions other than international tax, I'll give it a good go. So anyone else have any questions? Or by the way, just cut me off whenever I've run out of time.
No, to be fair, I wanted to kind of ask that as the last question, because in the startup sphere, it's quite popular, especially when like the high growth startups that aim to be
Aim to try and do overseas.
Googles, they usually set up in Delaware, the US, which is a widely accepted way to set up your company to get American investors on board, etc.
Yeah.
So I exactly wanted to ask that.
Yeah. Unfortunately, I don't have knowledge on that. Sorry, but I could look into it for sure. If it's a common thing, I can look into it and come back to you next time. There's loads of clever people in our office that I can ask. That's the beauty of working for a bigger firm, is that I don't need to know everything. I just need to be able to pass. Anyone else have any questions, or is that it for now?
Last question on some mechanics. So
Yeah.
I set up for £13. Like the second that you set up a company for £13, that's the moment when you need to be paying. Was it? You said 19% on.
So it's assessed on an annual basis. So if you set up your company on what do you remember what date?
3 years ago.
All right. Let's say the specific day was the 2nd of February, right? Your first year, you don't have to worry about corporation tax for quite a while. Your first year will run to the 28th of February of the next year. So it's just slightly over 1 year. And then you get 9 months to calculate, do your accounts, calculate your corporation tax, and then pay it. So if you've not paid anything to date, I'd look into that, because you should have done.
Right.
You don't pay tax all the time. You pay it once a year, typically 9 months after the end of your year, which is usually 12 months.
So with a CIC, could they get like startup funding from like an investor?
Yeah, 100%, 100%.
Yeah, and government grants as well.
Absolutely. The caveat with CICs, it's not all good news. The caveat is that, and I've not looked into this for a while, I believe this information is still accurate, you need to prove that you're retaining 33.3% of your profits in the business and reinvesting it into the mission statement that you said you were going to do. You can't have it all. That's why it's a hybrid between a charity and a company. Yeah. There is an element of confidence there, where the investor's like, you're not going to run away with all my money. Also, assets, like even as simple as laptops and stuff like that, have to remain within the CIC. You can't just buy them in the CIC, then look around one day and run away with them. That's part of how a CIC works, is that everything that's bought in the CIC stays there. Unless you're transferring it to another CIC, sometimes you're allowed to do that. And there's also a list of, you can Google it, there's a list of places you can transfer assets to. They're usually charities and stuff like that. So there are a few little caveats, but nothing that would stop, it encourages investment. But you just have to know that you just can't take all the money out that you want, basically.
Yeah. And you can pay yourself like reasonable.
Pay yourself salaries. Yeah, absolutely. Yeah. Are we all done? Okay, cheers. Thanks everyone.
Thank you so much.